A billionaire, a trade court, and the Fed walk into a bar. No, seriously, what's going on isn't a joke. And if you connect the dots, there's a gold mine hiding in this mess. By the end of this video, you'll know the true story behind a billionaire hedge fund legend warning that we're steps from collapse, tariffs declared illegal and then instantly brought back, and the Fed and the White House at war, and the US economy just shrunk for the first time in 3 years. And yes, for the first time in maybe a decade, buyers are actually winning in the housing market. If you think this feels like a game rigged for insiders, hey, I get it, because that's exactly what I'm seeing. So let's break down the dominoes that are falling and the real moves to make right now. So Ray Dalio, founder of Bridgewater, the world's biggest hedge fund, he just dropped a bomb. He said, we're in a critical situation for a financial crisis within a year or two. Now Ray, he's not some doom and gloom YouTuber. No, this guy called 2008 and manages $140 billion for a reason. But here's what's different this time. Dalio isn't just screaming about debt. He's looking at the collision of two monsters, America's crazy debt binge and the insane costs of the new AI arms race. You probably saw Trump's trip recently. Well, this AI thing is becoming a really big deal. Here's what most people don't realize. The US is burning through $25 to $30 billion annually on AI development. China, they're spending 15 to 20 billion. That's serious money on top of everything else. Most people are staring at interest rates, but I'm asking a different question. What if the next bubble isn't housing or tech or anything that the Fed is involved in, but the cost of keeping up with AI? Right when the government runs out of rope. Think about this. Our debt to GDP ratio is now 40% higher than it was during the 2008 crash. We're way more leveraged than when the whole system nearly collapsed. Dalio says the Congressional Budget Office's numbers are just scenarios, not certainties. Translation? Don't get hypnotized by the official story. The real risk is the domino you're not watching. Here's how I see it. If you're only watching what everyone else is watching, you're already behind. And speaking of things changing fast, check out what just happened with tariffs. Last week was wild. On May 28th, a US trade court rules Trump's tariffs illegal. Then, literally the next day, an appeals court brings them back. Reuters says this legal ping pong has already cost American companies $34 billion. That's not some abstract number. No, we're talking about actual paychecks, lost jobs, and busted supply chain. The judges said Trump doesn't have unbounded authority to slap tariffs on the world. But then the appeals court hit pause, keeping the tariffs alive while the lawyers fight it out. When the rules can flip overnight like this, the slow and stubborn lose. Fast movers and flexible thinkers win. While most people are sitting around hoping for clarity, you should be asking, how can I pivot before the crowd? Here's what I'm watching. Which cities and industries rely heavily on cheap imports? Which ones are getting hammered by higher costs? Because tariffs aren't just about expensive gadgets. No, they create ripple effects that hit real estate values in trade-heavy cities and kill jobs. If you're thinking about this the right way, you're already asking, where are sellers getting desperate? Where's capital fleeing from, and where's it rushing to? Want to know where the next domino falls? Follow the pain and the opportunity that uncertainty creates. History shows us the pattern. I mean, every time global supply chains get rocked, whether it's tariffs, war, or policy chaos, certain places get hit first. Remember Detroit during the oil crisis? The Midwest when trade wars kicked off? LA ports during COVID. Property values in those areas dropped fast. Sellers got desperate, and smart money swooped in for deals before the news caught up. Right now, same story playing out in Midwest manufacturing towns, in port cities, and export-heavy farm regions. They're all feeling the squeeze. But if you think that's chaos, wait till you hear what's happening between the Fed and the White House. Jerome Powell, the Fed chair, just met with President Trump yesterday as of this recording. And on paper, they're discussing growth and inflation. But come on. If you've been paying attention, you know Trump's been hammering Powell to reduce rates. Powell actually had to tell Trump that monetary policy would be based solely on careful, objective, and non-political analysis. The fact that he even had to say that should be concerning. But here's why this matters. When the Fed stops being boring and starts being political, everything gets more dangerous. Goldman Sachs ran the numbers because they're warning that if the Fed caves to political pressure, we could see stock prices tank, the dollar weaken even further, and inflation spike all at once. They've seen this movie before in other countries, and it never ends well. So here's the thing. Don't wait for some formal press conference. Run the scenarios now. Like, if Powell caves to Trump's pressure, do we get a little rate relief, or does inflation suddenly spike? If he stands firm, do assets tank? What happens to your cash, your debt, and rental income if things get choppy? Me? I want my financing flexible, my cash stack healthy, and my assets in places that do well even when the government loses control. You don't wait for the all clear. You position yourself before the news hits. Here's what I'm actually doing. I'm locking in lines of credit now before lenders tighten up. I actually just got approved for $150,000 at 0% interest through loopholelending.com, part of my strategy to have dry powder ready. I'm also stress testing every deal against higher interest rates and making sure that I've got exit strategies if buyers disappear. Plus, I'm focusing on properties with strong rental demand, because when chaos hits, people still need somewhere to live, and that keeps your cash flow alive. The point is, make your moves before the headlines force everyone else to react. I mean, think about 2007, right before the crisis hit. Smart investors who locked in cheap long-term financing and prioritized rental properties were able to hold on and even scoop up bargains while, everyone else was forced to panic sell. The ones who waited for the all clear, they got blindsided by frozen credit and crashing values. Timing and preparation made all the difference. But while everyone's arguing about policy, the real economy is already showing cracks. For example, here's a headline that I had to dig a little bit for. The US economy actually shrank by 0.2% last quarter. Not less growth, actual contraction. First time in 3 years. Now that number is a bit skewed because Apple shipped in like 5 plane loads of iPhones from India just before the deadline. But here's what matters. Companies are so spooked by tariffs that they're scrambling to import everything that they can right now. Meanwhile, consumer spending, it's slowed to just 1.2%. That's the weakest in 3 years. Corporate profits, falling off a cliff. When Americans stop spending, that's when things get real. This could signal a bigger shift from endless growth to a much harsher reality where just breaking even counts as winning. The biggest risk here isn't just prices dropping, it's getting trapped, unable to sell or refinance. I mean, think musical chairs, except half the seats vanish while you're looking the other way when the music stops. And all of this, the chaos at the top, the legal flip-flopping, the policy battles, and now a shrinking economy, it all lands right at home with the market everyone cares about. Housing, where all the dominoes finally fall. Housing Wire says demand is technically up, but here's the reality. Redfin reports prices falling in 11 major metros, the most widespread price drops in 19 months. The median mortgage payment is $2,860. That's just $25 shy of the all-time high. 14.3% of deals are getting canceled. That's the highest for this time of year since COVID. New listings are up 12.8%, but buyers, they're evaporating. And those peak era sellers who've been holding out, they're finally throwing in the towel. But here's the thing about real estate. It's local. And this is where it gets interesting. These scary headlines might be true for much of Florida and Texas, but places like Cincinnati, Kansas City, or Indianapolis, different story. Affordable homes and steady local economies are keeping demand strong and prices way more stable there. Quick question for you. Drop a comment below. Is your local market feeling this crunch yet? Or are things still normal where you are? I read every comment, and honestly, you often spot trends before the experts do. The real issue this time isn't just about prices dropping, it's about liquidity. Can you actually sell if you need to? Are there enough buyers to keep the market moving? If you're on the sidelines, keep watching, but maybe consider getting up from that rocking chair. If you're selling, stay nimble. If you're hunting deals, Don't settle for just okay. This is when fortunes quietly change hands in the right market. Look, the biggest risks aren't the ones everyone sees coming. They're the dominoes behind the dominoes. Remember what I said about that AI spending, that $25 to $30 billion annually? That's on top of a debt load that's already 40% worse than 2008. Something's gotta give. And I never trust the system to save me. I trust my math, I trust my plan, and my ability to move before the herd. Keep your creative strategies sharp and focus on real returns no matter what the market does. Cash flow is king. If things turn south fast, you want to be positioned to ride out the storm, not forced to sell at the worst possible time. The opportunities are there if you know where to look and have the guts to act while everyone else is frozen. Remember, every crisis creates winners and losers. The difference? The winners saw it coming and positioned themselves accordingly. Here's what's crazy. While everyone's panicking about the coasts, there are markets right now where smart money is quietly moving in. Next week, I'll reveal the 5 cities where investors are finding opportunity amongst this chaos. You might be surprised which ones make the list. Remember, in times like these, being informed isn't just smart, it's profitable. Oh, and one more thing. Since I mentioned that I focus on off-market deals, I've received requests about how that actually works. Look, when markets get choppy like this, the best deals usually aren't on the MLS. They're not on Zillow. They're the ones where you're talking directly to sellers who need to move fast. I put together a simple 5-step playbook that I use for these conversations. It's literally the exact questions I ask in order. Nothing fancy. If you want to see how these deals actually happen, I'll drop a link to it below. It's free, no email required, just a Google Doc that you can click and save. Fair warning though, it's not for everyone. If you're not comfortable having real conversations with sellers or you're looking for some magic script, this isn't it. But if you want to know how off-market deals actually get done, it's all there. Anyway, that's it for today. Thanks for watching. I'll see you next time. Take care.